Hey everybody, it's Mike here from AdventuresInCRE.com. Today I'm going to go over the Real Estate Acquisition Model 2.0 that was just recently uploaded to our website. If you haven't done so already, please head over to AdventuresInCRE.com and you can download it and then come back and follow along. So to give you a brief overview of the model, it's broken down into 3 sheets. We have the inputs and monthly cash flow sheet. We have our annual cash flow and returns, and we have the amortization schedule. So let's start on the first sheet, which is the inputs and monthly cash flow. We have on the left our inputs section, which includes the property inputs as well as our debt inputs. And then on the right we have our monthly cash flow, which has our unlevered cash flow on the top and our levered cash flow on the bottom. So let us first dive into our property inputs. So I'm just going to walk down. A lot of this is self-explanatory, but let's just kind of walk through everything. We have our analysis start date, which is governed by our month. And you can see we have the drop-down menu, which will give you any month you want to start with, and you can pretty much click whatever month you choose. And additionally, we have our year, which you can manually input. So change that to 2016. And you can see as these two cells govern cell D19, D19 is also governing J13. And then as a result, row 13, these months will follow suit. So whatever happens in J13, the next months will follow after in that row. So walking further down, you can insert your property name, and now whatever you put in your property name will flow up to the title, and also whatever you put into the city will also flow up into the title as well. So for example, we can change this to, I don't know, let's say Comcast Center, which happens to be an actual building in Philadelphia rather than the fictitious Terrapin Station Center, which is a node to one of my favorite musical groups. So anyway, we can continue. So property square foot, we have 50,000 square feet. Purchase price is all very straightforward. We naturally get our going in cap rate, which you can follow the formulas. If you're unfamiliar or you're just new to real estate, you can look up into the formula box to kind of follow along with what's going on and how these formulas are being calculated. For those who are more experienced in real estate, you will for sure know what is going on here. We have closing costs, and then we have our hold period, which will allow you to, it's another drop down menu, and we have up to 10 years. So you can have a 3-year hold, and if you will notice, if we scroll to the right on our monthly cash flow, after 3 years, so these are the years up top, after 3 years everything will go blank under NOI, and our calculations up to NOI will go out for an extra year. And the reason this happens is because if we scroll down to the bottom, we have our going out cap rate, and now this is based on the following year's NOI. So for example, if we want to sell our building in year 3, well, we can scroll out and it will basically use this row right here, which is the next year's NOI, and it will add it all together, and it will bring us, it will divide that by our going out cap rate to give us our sale price. So that explains our hold period. And then in this box, everything from row 34 to 38 in column C and D, this will give us our first year's gross potential income. And then expected vacancy loss will calculate obviously the row that says expected vacancy. And then you have the ability to manually input additional vacancy, and all of this will come out to our effective gross income. So for example, we have gross potential rent. You have a spot where you can add reimbursable expenses, miscellaneous income. And so unfortunately, you know, the model that's going to be uploaded to the website is not going to go into such depth where you can put in individual tenants or you can calculate reimbursable expenses. So You would obviously have to do all this stuff offline and then plug it into the model, and the model can grow your inputs from there. And what I mean by that is in column H, you have the ability to grow gross potential income annually, taxes, insurance, common area maintenance, and then CapEx and miscellaneous expenses you have the ability to grow annually. So speaking of expenses, let's go into the expense section of the property inputs. You have the ability to input taxes, and then you have the ability to pick which month you want your taxes to be paid. So if we go up to the row here, you see we have taxes, and as you can see, we have July 2016. So in our tax payable in month box, you can scroll down, you can pick, let's change this to September. And if you look now, our tax is being paid in September, and then every year following that, it's being paid in September, and it will keep going. It will keep going all the way throughout the entire model. And this will have the same effect. You can do this with your insurance premium as well, and they will grow at whatever percentage rate you type into these boxes. So below that, we have CAM, which I arbitrarily put in as a percent of property value for year. And actually for the model that you have, I'm changing this. I decided I'm just going to put in a dollar amount that you can grow, and you can pretty much figure out what your first year CAM is and just put it in. Property management fee at 3% of effective gross income. It's effective gross revenue. It's the same difference. Below that, we have average annual CapEx and miscellaneous capital expenses, which says 5,000, which is probably pretty low for this property, but maybe I'll update it for your model that you have. Under that, we have a major capital improvement cost. So this was a cool feature that I put into my the first version of this model, and I decided to keep it because I thought it was a pretty interesting functionality. So this gives you the ability to have one major capital improvement cost in your model, and you can pick when it is by choosing the month and the year, and then you have the ability to have it financed by the loan. So here we have $100,000 expense, and we're saying yes that it's going to be financed by the loan, and we're going to say it's being funded 65%. So let's go into the monthly cash flow and let's find March 2018. So we have March 2018, and if we go to the one-time capital improvement, major capital improvement row, you see there's $100,000 expense here. Now if we go to the levered cash flow, which is the cash flow below, you can see there's only a $35,000 expense, and this is because we're funding this capital expense. We're funding 65% of this capital expense, as you can see in cell D51. And so when you fund this, let's go over to the amortization schedule. What happens is it'll find out which month this is in the analysis period. It'll find the month, and then this amortization schedule will identify that month, and then it will add $65,000 from the ending balance. So you'll see it grow here, and then it will re-amortize the loan so that by the end of the period, sorry, I'm using the mouse a little too much here, it will be back down to zero. So I won't explain the details, but the formulas are there for you to figure out how that functionality works. So we have the going out cap rate, I already explained that, and then we have our selling expenses, which is calculated into on the sale date. Below that, we have our debt inputs, and this is fairly straightforward. We have our loan to value, we have our interest rate, we have our amortization period, which we max out at 30 years, so you can't go above that, and then we have the ability to put in points. So that pretty much explains the inputs and monthly cash flow section. So let's move to the next sheet, the annual cash flow and returns. Here we have our monthly cash flows rolled up, and we have our unlevered and our levered. And to the left, you see some important return metrics, and you can look through these. While you're looking through it now, I'm not going to walk through it. Is basically what I'm trying to say here. Below that, we have the sensitivity analysis, and here we have the ability for you to alter the purchase price, and you can see its impact on levered IRR. So right now we have the purchase price at 12 million. I'll just show you how this works real quick. Let's just put 10 million in there, and you can see that it will alter this cell. So this changed from 12 million to 10 million, and then you have the ability to change the incremental growth and the incremental, I guess, how it decreases in value as well. So you have the ability for it to go both ways. So we can change this to, let's say, 500,000, and you can see how these will change accordingly. And below that, you can see the whole period impact on levered IRR and how this changes the longer or the shorter you hold the property. And so the final sheet, which was, we already went through this, is the amortization schedule. Sorry, I'm using a bunch of different keyboards these days, so I have to get used to each one as I change computers. Yeah, so that's it. That's the entire acquisitions model. Again, you can go download this for free on adventuresinstereo.com, and feel free to get in touch if you have any questions or concerns, or if you just want to discuss the model. So thanks.